Let's jump into things. Where are we at? So it's 12 past 11 on the 11th of September. September 11. Um, Came to my notice and that I've actually been sort of saying that it's August for like the last week. So yeah, that's why I thought I'd get back to actually sort of stating when it's at the start. Anyway, let's jump into things. So a little bit of data from overnight yesterday. So look, I'll start off with China data because China data can be a bit of a hit and miss thing. It sometimes can affect the market, sometimes not really sort of have too much of an impact. But it actually sort of had quite a strong impact, particularly on the Aussie yesterday. And Aussie absolutely cruised, also New Zealand dollar, but I don't really follow New Zealand dollar as much. But they had their sort of the CPI and PPI come out, and as you can see with the numbers, PPI was in line, and CPI was actually dropped down even lower. So I did a little bit of sort of reading in there yesterday, that, and I've been saying it's disinflation, but this is deflation. So the difference being that disinflation is basically above zero. So if you're, like as I said, you're trying to sort of improve, like an economy sort of targets or tries to sort of look for a growth of inflation of 2% to be a sustainable level that's not detrimental by way of sort of like prices going up too quickly. But of course, if prices are going up too slowly, then that can also have a detrimental effect, and particularly in the position that they're in now, sort of below zero. So you're seeing deflation. So a reduction of inflation levels, so as in like where we've been for the last couple of years now. So 7%, 6%, 3%, moving down like that. That's disinflation. But what they're actually seeing here below zero is deflation. And that's a bit of a sort of a bad position for economies kind of to be in because, when you're in that sort of position, like, prices are getting cheaper and cheaper, which all very well sounds good. But, the people sort of selling things, well, they'll just end up sort of stockpiling what they've got. Because what's the point of sort of buying more stuff if in a couple of weeks and that you can just, like, you can sell it and sort of and get more product in. So basically, sort of like, if you were to sort of like be a business and sort of like, okay, look, I could sort of like invest in this new thing, or I could sort of buy more stock of that. Well, why buy it now when, in a week's time, month's time, whatever? Oh, I mean, obviously, given the level of deflation there, things are going to be cheaper. And if people aren't buying things, well, that slows down the economy. And of course, then sort of like, can lead to problems with unemployment and all this kind of stuff as well. So basically, look, it's not a good place for an economy to be in. And generally, it's sort of like, the reaction with this sort of thing would be of sort of obviously, cutting rates and reducing rates, more cash into the system, which is the polar opposite of what we've been seeing with everything, like all economies in the West kind of thing, but all the sort of major economies that have been dealing with inflation the last couple of years as at the forefront. So it's a thing to sort of wrap the mind around, but certainly it's not a good place for them to be in. It should see a weakening of the yuan, but that's kind of not really what we're seeing, and we're still seeing the yuan continue to appreciate in value, and that is mainly just off the back of a weak US dollar. And this is what I've been sort of saying, that I think that yuan is something very important to be paying attention to now, because I think that's going to signal a bit of a spin and a bit of a turn, and I think that's got ramifications for the Aussie, and also I think it puts a handbrake on potential further upside, at least in the short term, medium term, for gold. So there is some sort of reason to reason to the madness with this kind of stuff. But as we still see US dollar under pressure, uh, you know, those things have still got a green light. And of course, there's other. It's not like, okay, the one weakens and gold goes down. It's not that direct a correlation with it all, but it is one of the sort of indicators with it all. Um, anyway, sort of moving on, we'll get to that when we get to the charts. The core PPI month on month over here, both of them sort of came in exactly the same. Now, this is one that I covered yesterday, and I said, look at these previous times that we've had these sort of spike ups, like, when I mean, we go, maybe cherry picking some of these things here, but we sort of came in. 0.7% came in at -1. 1.1 came in at -5. 1.4 came in at 0.5. They're all sort of quite large sort of drop-offs after we've had these sort of bigger spikes. And last month was a little bit of an outlier. Look, it was still strong. It's still way above where it's been for quite a while and that. So it's not really something you can just go, oh, well, it's not as bad as it was because they've obviously sort of revised this down and then it's come in much lower. But there is something to that, regardless of it all. And I think the way that the market reacted is pretty much exactly in line of that kind of thing. It was worse than expectations. It was a bigger drop off than we had last month, and last month was revised down. So, there's three ticks on this one bit of data to sort of say, hey, look, you know what? Let's get rid of the US dollar. And the US dollar sold off a little bit with that. But I think there's something to unpack with the fact that it, A, didn't just dump straight down as we've seen the market do time and time again, and also B, the fact that it actually bounced back up to reclaim its levels. It did so straight away, sold off a second time, and then sort of came up and then actually closed the day up near those levels again. And we've actually seen it sort of push up on open today as well, sort of with CPI coming up tonight. So that was a little bit of data overnight. Nothing else really. 10-year auction. Don't know enough on that to really sort of comment on this kind of stuff here. Let me just check. So actually just looking that up, just to sort of cover that a little bit at the moment, but it says the auction had a bid to cover ratio of 2.65. The bid to cover ratio is a key indicator, demand representing the total amounts of bids received relative to the amount of debt sold. A ratio above 2.5 is generally considered healthy. So this result showed a robust interest in that. So all in all, I think it was actually taken quite well last night, and this could be a slight little indicator of what we saw sort of like with that strength. Let me just drag this one across. So, see what I'm saying. So low yield for the auction. So obviously, sort of like I mean, more demand with things. Well, they don't need to offer such a high rate kind of thing. It's kind of like think about it, sort of like you're like, oh look, you buy it, no, I'll give you more. Buy it, no, I'll give you more. Buy it, no, I'll give you more. Okay, I'll take it. Um, in the other direction. But so this one is look, there's heaps of people here. Okay, well, okay, because there's so much demand for it, we can get away with just giving it this much. So it seems like, and also we've also got strong foreign demand here. Data from the auction showed exceptionally high percentage of bids from indirect bidders, a proxy of foreign central banks and institutional investors, with further underscored by strong global appetite for US government debt. So, I mean, this is something that we haven't really seen for a while, because obviously, sort of, a US dollar has just been the ugly duckling of all currencies, and now we're sort of seeing that okay, there is a little bit of a sort of interest in it, and obviously in the 10-year as well. So I'll have a quick look over the chart with the 10-year, see how that sort of reacted coming off that as well. Moving forward, we got RBNZ talking yada yada. We had inflation expectations. This is an interesting one because I saw this come up just before, and remember CPI we had last time. Actually, no, that's right. Sorry, I will before I say it, correct myself in that. CPI did go up last time, didn't it? So we had 3.9% going up to 4.7 with their inflation expectations. We had that 1% jump last time with inflation. So I guess that does go in line with things there. Moving up tonight, we've got a couple of big ones. We've got ECB, so they've got their rate decision. Now, this is pretty much widely called that they're just going to be sort of holding flat. I did actually see something interesting. I think it was this one here, if we're loading it. No. Now, this I thought was kind of interesting. Again, these things can change pretty quickly. But this is the kind of idea about sort of what you're kind of looking at, just in terms of sort of positioning, sort of coming into these kind of larger, well, not even just coming into these larger sort of rate decisions and that, but all rate decisions. But, it's just good to know sort of where they're sort of standing with it all. But as you can see, ECB, probably 99% probability of no change in upcoming meeting, 8 basis point cut, and this is by year end as well. So you can see that, the highest expectation of cuts is the Fed with 70 basis point, far exceeding everybody else. And that's because they haven't really done anything yet. So they've got a little bit of sort of catch up to do. But this is why the US dollar has been so heavily traded, because people are positioning for that sort of for that sort of rate cut. And as we've seen last year, when the rate cut comes, that kind of like just, we're over the hill, we're over the hype. So, and then, they move on to the next thing, of course, but that's the sort of thing that sort of weighs on it, leading into it. So the reaction we've seen, particularly last year coming into that 50 basis point cut with the Fed, was, sold right down. So, might as well show it with these things here. There we are, DXY. I'll trip back in time here. On daily. This is where they cut last year. So you had all this talk through here of 50 base point, sort of cuts are coming. It's going to be massive, this, that. And then the cut came and it was about here. So, you can't say that it necessarily came from the top necessarily just here, but, effectively 5% drop leading into the rate decision. And when the rate decision came, it actually bounced 161% of that whole drop. You drag that across there. Now, I'm not sort of saying that this is going to replicate itself, but the takeaway from this is that, the positioning happens before the rate decision comes. It doesn't guarantee that you get this big explosion up to afterwards, but, that was a 50 base point cut. I mean, the textbook sort of reaction definition of what a currency should do is drop down here. But you got to think they've been selling into this thing so much prior. Maybe it's going to be a buy the rumor, sell the news kind of event, and which that they'll go, oh, everybody's cutting, they're cutting. Let's sell into that and squeeze everybody. So we'll see how we go with that. But let's push on with the news data. So so we've got ECB sort of coming up. They're flat. So not really expecting a great deal from that. The bigger one of the session, I would say, is going to be the CPI over in the US, and core seems to be sort of fairly flat, but CPI year on year, this is ticking up. And while they've sort of said, like, jobs are at the forefront, it doesn't mean that they disregard inflation as the other sort of mandate altogether. It just means that they're not as equally weighted, or in this case, they're actually lopsided weighted, as they were previously. So it used to be sort of, oh my God, so twitchy, CPI's up, wow, boom, market reacts super fast off that. That doesn't seem so much to be the case. It's more sort of, what I mean, jobs is like the talking point. That's the thing that the Fed's looking at, and that's what the market's sort of positioning themselves based on every bit of data there coming out weak. We saw inflation, well, a level of inflation, PPI last night, very weak. That's another tick in the camp of, okay, well, we don't need to worry about inflation. If this does come in hot, it won't necessarily explode the US dollar to the top side, but it puts a little bit of a question mark over things. The higher it comes above it is the case. If this comes in flat, under expectations, you can expect US dollar to sell off. And, basically with them, we look forward to next week with the rate decision. Seems pretty much a sort of guaranteed sort of thing with 25 base point. There is a thing called the Fed Watch, which is, let's pull this up here. And basically what it does is sort of like, there is a sort of a calculation to this. It's not just so that some dude in a back room sort of making his own decision about it all, but how the market, based on sort of like bonds and yields and that the market is sort of pricing 25 base point cut here and obviously 50 base point there. So there is a very small sniff of a chance of a 50 base point cut, but as you can see, there is absolutely zero percent chance of a hold baked into the price. So look, if they hold, US dollar's going to rocket. Gold's probably going to get a smack with that as well. But the likelihood, most likely, is this 25 base point cut. And if we get that, it's not going to be a shock. And that's my point. That's sort of like, it's not like, oh, well, they're going to cut, and they cut. It's like, market doesn't fly on, okay, well, that's what we thought was going to happen. That's what happened. Market flies on, wow, we were pricing for this. Something different happened. Let's really fast react to that. And particularly if they do hold, if part of the people, 8% chance potentially, and we're not talking about sort of like Joe Blow on his computer in his underwear. We're talking about the people that have got the money to move the market. If these people have to unwind and these people have to unwind, US dollar would rocket. I don't think that's going to be the case. I think we're going to get a 25 base point cut, but that is the idea. As you can see, nobody's positioning themselves for a hold. So if they hold, that's going to be a big shock. And that's the point that sort of I'm saying with the inflation, that look, it's not their sort of, that's not the dominant sort of mandate that they're looking at the moment. But if this does go up, it does put a little bit of a question mark on. And the higher it goes, the bigger the question mark. But most likely it's not going to be enough unless it is outrageous. And it comes in at like 4% or something, 3.9%, which sounds ludicrous, but remember, that's what happened with the RBA. The RBA went up 1% in one print. It doesn't move like that. This is how it moves normally. Look at the previous stuff here, 2.7 to 2.9, 2.9 to 3, 2.9 to 2.8, 2.5 to 2.4. You know what I mean? It doesn't move 1% in one go. That's why the RBA, like that last print, with the RBA and the CPI there was so drastic. So it's just something to think about sort of coming into the data tonight as well. We also got press conference half an hour after, so it's going to be quite a little busy period through this bit here. But after that, it looks like it's pretty much smooth sailing. We don't really have a great deal tomorrow morning, and then it goes consumer expectations, confidence, and that sort of tomorrow night. We'll get back to that then. All right, so a little bit coming up here. So obviously jump in with the charts and that. DXY does kick us off. And this is the point of what I'm sort of saying. So yesterday there was the two levels that we were kind of looking at. This little level through here and then 98 as the round number. I said above 98, possibly a squeeze. I still think this is in line. I think this is a potential as a trigger point. As to whether we get it now, I'm probably not too sure about that because realistically, the markets tend to go pretty quiet before larger bits of data. So, I've said this a few times, but CPI, NFP, they're the second tier bits of data for myself. Just for myself, but that's just what I call them. FOMC being the only one that is the tier one data or the rate decisions, but really just the FOMC. But point being is that coming into these large bits, you're not taking a wild stab guess now in this session. So the likelihood of this breaking out earlier is probably pretty low. But as you can see, it's remained quite big. So this, if we get onto the lower time frame, we can see the reaction of how that happened yesterday. This is where PPI happened, bounced straight back up, and then sort of came down again, and then obviously moved through here. So 1 o'clock, what time was that auction? 3 o'clock, 3:01, which is odd sort of time. 3 o'clock here. I mean, it was kind of recovering prior to that anyway. So, anyway, point is, we've got a nice sort of little setup here. This is actually, so I drew this sort of last night around this time that this bounce, this little sort of falling support here. This is very sort of silver-esque with its price action. Silver loves to do these kind of breakout points, so it's deeper, deeper, deeper. So this is actually a bullish setup here at the moment. So, I'm not sort of surprised that, this morning pushed up against that resistance line there again. And this does actually lead it to the idea that you are moving up higher. So, as I said, it's not typically something you probably sort of see so much with with US dollar DXY, but this is very, very much. I've covered it a number of times that this is a setup that you see with silver. And we haven't seen it a great deal recently. I haven't covered silver so much in that recently, but previously that is very much what it does. And the idea being that it's obviously dragging in more shorts because everybody loves to sell US dollar. I mean, look at this. Generally, if you step right back, we're still kind of drifting down. We broke this horizontal. I put it into a new sort of little downtrend channel because, it seems to line up pretty well, I'd say. And, people love it. They're like, oh, it's broken the lows here, broke the low, retested, made a new low. That's all textbook, yeah, we're going down lower kind of sort of stuff. So, there's a lot of people positioning themselves for more dollar weakness, which means there's a squeeze potential up to the top side. And if your CPI comes in hot, well, that's a good reason to get yourself back up over to these levels over here. But as you can see, this falling resistance, if this is the channel, you've got to respect both sides of it. And that means that most likely you're going to get a reaction should we sort of push up into this level over here. So a break up here, I imagine, would see some sort of pullback or profit taking, whatever you want. But as you can see, with this little sort of setup here, they're sort of making lows, taking out the lows. They're dragging in. Look, oh, here we go. We got a lower low. Let's get short again. Moves right up, takes out the high, stops them out, and so on and so on. So look, it doesn't mean, nothing's 100%, but that is a kind of a bullish setup here because it's like people want to get long, stop under this, take them out. Stop under this, take it out. Stop under this. Generally, 3 touches is enough down here. If this sort of comes back down over here, I'd kind of be questioning it. As I said, I drew this last night, this falling resistance here, and I said, look, if this makes it back up to the top over here, we're probably going through here. It did make it up here, obviously dribbled off into the close. And this morning, a little bit of a gap, closed it straight away. So we got no worries about sort of gaps and that to sort of drag us back. Because this is the thing, I sort of say these gaps, look at these things here, they close. And that's what you got to remember. They pretty much close. That's what you got to remember. With the gaps, with DXY, it'll either close straight away or it'll be a magnet for a movement sort of through into Europe. As we can see, what time did this close? This closed, kind of technically closed here because that's at the bottom of the candle there. So 2 o'clock. So end of Asia, starting to move towards Europe, close the gap. But the point is, if it leaves it open, it's a magnet to come back. This one sort of gapped down, I suppose, and then shot straight up. So, there's no worries about gaps with this sort of thing here. So if we flip and move up here, we got a little bit of resistance at 98, but that's your trigger point to sort of move up over here. So as I said, slightly bullish setup, at least in this sort of little short-term bit here. Squeeze potential because everybody sort of wants to sort of rag on the US dollar so much. So should it break up above these levels, I'd expect a little bit of a squeeze. But again, topside's limited. You're not going to get major breakouts prior to FOMC next week, and particularly because jobs is the main thing that they're looking at, and CPI coming in hot may put a question mark over things, may sort of give you ability to squeeze out some sort of short positions and some bears, but it doesn't mean, oh, hold on, wait, bang, that's what we're talking about. You know what I mean? Like, it's their main sort of mandate that they're looking at is jobs. Jobs is weak, so that's why you're still seeing a slow drift down. But it doesn't mean you can't have little periods of pushing up to the top sides over here. To get a big breakout over here, you probably almost sort of need them to either hold or 25 base point, I would say, because the market's very much sort of positioned for that. Yeah, we'll deal with that when we get to that. All right, so in terms of sort of levels that I'm kind of looking above today, look, I take out yesterday's high. You are still coming into sort of 98, so pretty much I'll sort of bank it in at the same levels as I had yesterday, which are 97, 90, and 98. Above 98, squeeze. I'd be surprised. Like, look, you could see a bit of a push up here, but I think any sort of push up to 98 is going to be capped in that. We're going to have to wait. As I said, I don't expect a great deal prior to. Excuse me, prior to CPI tonight. We'll sort of see how we go here. I suppose underneath 97.70, you might see a little bit more of a dribble back down. But as we can see, they are being bought up each time they take the drops down. If it does decide to come back down over here, you're really coming down back into these 97.4s. And to me, that's almost a little bit too much. Like, DXY is not afraid of deep pullbacks, but as you can see, it's tried to rally a few times. It's not just a single straight pullback to then sort of push back up. They've tried, and I think if it gets back down here, it's going to be in trouble. But I'd expect probably a little bit of a consolidation to a push up through this session. but I still think it'll be capped 98 prior to this data. Have a look at Aussie. So Aussie was an interesting one. So it obviously benefited off that sort of weak US dollar. Again, same sort of bouncing kind of thing. You saw the data come out, bounce right back down, and then sort of grind it back up. It did find resistance pretty much on point of this sort of larger wedge, which is kind of in line with what we've seen here previously. But if anything, it's just filling it out a little bit here. We're not really seeing anything break down. We saw, as I said, we had that inflation expectation data come in before. Obviously, if they're expecting higher inflation with it all, well, that removes the idea that we're going to be seeing as many cuts. I don't think it's like, okay, it's not. It's going to be sort of that we're not looking at cuts. It's going to be more that, hey, most likely there's a chance or a pretty good chance that we're going to hold next time. And that's obviously Aussie sort of bullish. That China data that I mentioned before. So yesterday they had their sort of PPI. This is as I said, I think a lot of this movement comes off US dollar. US dollar is the driver because the yuan shouldn't appreciate in strength based off a lower PPI. That's just not how things would typically react should that be the actual driver that they're moving off. So there's obviously other things at play in that sort of situation. But certainly, sort of, Aussie benefited very much. This was the move through yesterday, where we saw that data. Data came out at 11:30. So this is 11:30. So that's where the data came out, and as you can see, it was just one-way traffic all the way up through here, through till, as I said, we saw a little bit of a pullback into sort of end of Asia kind of thing after US dollar had closed that gap, and then we saw a little bit of a balancing act through there. But look, at the moment it is still obviously sort of grinding higher. I think really it's got to get back underneath 66 if you want to see it. Excuse me, any sort of downside. A sort of turn around here if we do see US dollar sort of drag itself up a little bit, might, if nothing else, just sort of weigh a little bit on this sort of on this move up here. Like it did move quite well yesterday, but as you can see, kind of really is given back pretty much. Where was that? That data drop points at 66.03. Came back to 66.08 this morning. So look, it's definitely still holding in there. I did actually sort of draw this out on, is it on this one? Maybe it was on the other one. To sort of like worry about, well, not worry, but let's get rid of this weighted thing. There we go. The drivers of Aussie dollar, and you can see why this thing is moving up. So weak US dollar, well, that's a positive for Aussie. Stronger yuan, that's a positive for Aussie. The RBA, as I just said, like, the fact that they're potentially considering more of a sort of cut kind of situation. Sorry, not a cut situation. They are looking to cut, but with a higher inflation and that, they're looking that potentially that they might they might question whether they hold or not, because obviously you can't have inflation get out of hand. So that's a positive for Aussie, even if it's just in the short term. And then you look at risk appetite, and risk appetite, despite everything, maybe I'm just stuck in the little algorithm of the world, but seems like everything's going pretty bad at the moment. But you've got Russia, Ukraine, you've got Russia, Poland, you've got sort of obviously Middle East guys, and Israel sort of just bombed these people in like Qatar, so expanding that stuff over there. But despite all that, equity markets are still pumping near their all-time high. So I just sort of call this basically risk appetite based on sort of how the markets are moving, and the markets are saying, yep, let's buy more, buy more. So look, you've got US dollar weak, which is obviously the strength. You got one strong, which is the strength there. You got potentially the RBA considering possibly a hold, that's strength there, and then you got equity markets at the highs. So look, it has got that. If nothing else is going to ever say that the Aussie's got reason to be moving up, that's it right there. So obviously US dollar is the bigger driver for. So if we see a push on US dollar, this could be enough to overtake all these things here. Because if you see the US dollar strengthen, the yuan's also going to weaken. So that's going to twist two of these things. Risk appetite, this could potentially turn if we do see a US dollar sort of run, if we see sort of a little bit more of this sort of war stuff sort of come into talk, and RBA are just idiots, but they're a small kettle, small fish in this kind of whole situation. So if we do see US dollar run, that's going to be the new outlook for it all, and that's going to trump any sort of upside for Aussie moving forward. But as it is right now, that's not what the case is. This is what the case is right here. And you've seen Aussie continually bounce back, bounce back, bounce back. It's actually taken out highs. This is like 10-month highs or almost yearly highs for Aussie at the moment. But that's a little just dirty, what's it called, sort of dirty, rough raw, or whatever, analysis of why this thing may be continually bought on every single dip. Now, it doesn't mean that that's going to hold forever, but it does give you a good idea of why this thing's just gone straight back up here from almost breaking down 64.20 to bouncing up another 200 points, which is like 3 and a bit percent. So, there's no sort of shock as to why it keeps moving up, but as I said, they're the factors that are driving it, and that's what we're going to have to see turn around for Aussie to also turn around. But a lot of it really hinges on US dollar. Because US dollar sort of being so weak makes the yuan so strong, which Aussie loves. Aussie's obviously against the US dollar in this case, so that's obviously pushing it up there. And as if we see these equities maybe come off after this sort of rate decision next week, that could be a driver for it as well. Because I'll move on in a sec, but the rate decision, you got to think about these things. It's sort of like, why are they cutting? Why is the Fed cutting? The Fed's cutting because things aren't super rosy because they're trying to stimulate. That's what the rate cut is to stimulate the economy. Well, do you stimulate an economy that's doing super well? No, like you know what I mean. So possibly that could see a little bit of a sort of a sell-off in or a little shift in risk appetite across the market there as well. And Aussie is a risk asset. All right, let's power on. We got gold. Actually, sorry, with Aussie technicals. So it's a lot of rabbiting on um, with a sort of bit more of a fundamental idea. Look, top side. This is what we're looking at here. So I'll put these sort of larger levels in purple. We'll make these ones smaller zones. These are things that we can work off here. It's kind of chopped through, maybe holding the top side, but the fact that it's danced around this a couple of times, I'm not a big fan of. I think this probably is the level that you're looking at, and this is just like a little bit of what we saw yesterday, where we've got a support, dips down underneath, and then fires back up. That's exactly what we saw yesterday through this little zone here. Support, little dip down, and then fired up and sort of shot up to the top side here. So as I said, look, there's still a lot of reasons for the Aussie to sort of stay bid over here. The only thing that's really going to get this thing to turn around is US dollar running. So that's why I'll sort of set a couple of alerts for the US dollar running. I think sort of realistically, most things are just going to sort of just trade sideways through today. I think top side, maybe you go back up and test 66.30. Close above 66.30, okay, you move on. But you still have a couple of sort of resistance levels coming up over here in the 40s. So I think top sides are going to be capped over here. But certainly, I think if you can get back down underneath, say, 66, I think that's kind of opens the door to this test down over here. But that'll also take you through this rising support out of this wedge, which is sort of more of a downside reversal. So, if you want to sort of be 100% sort of cautious, you'd say sort of down underneath 65.80 would be your sort of sell down bit. But that's a trade through there, 66 down to 66.80 with potential. You got to get a close down underneath here, but that's kind of your swing low. I guess your swing low is actually probably more down here. But I would say most likely we're just going to trade sideways today. A little bit of a move up to 66.30. I imagine you probably get some profit taking again. So something similar to this. But I think that's pretty much what we're going to expect. This is more just planning for should we see US dollar run. But as I said, as it is right now, there's reason for Aussie to be buying dips. Above 66.30, I think that's going to be, you're probably going to come into these bits of resistance. You get reactions here, but I would say you're probably going to be moving up probably another 30, 40 points or so, should we get to there. Gold. So gold was an interesting one. Yesterday, this is where we did the analysis, and I sort of said, look, if it breaks through this, what's it called, 36.17, then we could be ready to go. I think it sort of rolled over here, got to 66.20, and then just bounced and dribbled back up. So no trade with that one there, but it's still a line that I'm interested in. And as you can see, it sort of had a little bit of a um, horizontal setup here. We are technically through this channel. Now this channel is from kind of actually that big breakout point. So this was the point where sort of I was like, oh look, it's a wedge, it's a breakout, maybe it's going to come back down here. And I said, look, there's your there are your battle lines here. So this was the point. I was like, look, this is your battle line here, and obviously wherever it pulled back to, this is your battle line here. I actually sort of jumped in a little bit early because it broke through and then shot back up. Regardless, anyway, that's where the channel sort of comes from. We can see that obviously it's dribbled through and come out here now. So, it's not technically what you want to sort of see with a channel break. With a channel break, you want to see fast action. You want to see a breakdown and move straight down through out of it. That shows that people have their stops around those areas. They're sort of, look, I'll trade this long till it breaks the channel, then I'll get out. This hasn't been the case. So realistically, still 36.17 is that level you want to see underneath, though there's going to be a lot of support. You know what I mean? They're not just going to give up on gold just because it breaks this one channel, but it does mean that you can start to see a little bit of a cool down, hence this sort of fib that we got set up here, and levels in which we probably could expect buyers to sort of step back in. But these are the kind of levels you're probably looking at around these fibs where we've seen a cluster of sort of back and forth. I imagine this will get a reaction. If it breaks it on a second time, that's where you go. Come down to these sort of like support levels around here, around sort of 35.45 to 35.20. They're the kind of levels that you probably expect a little bit of a reaction again. Get that off there. And so on and so on. So you know what I mean? It's not going to break and just go straight back down, but it doesn't mean you can't get a little bit of a short pullback through here, back down to these mid 35s before buyers go, hey, let's go and do it again. Because the structure of all these sort of things is exactly the same. It doesn't matter what time frame you're on, but as you can see, it's sort of like, it moves up, finds resistance, comes back, comes back here, drags through, makes a new high, comes back here. Now it's this one level here. So this is a little warning sign because this one obviously put in a lower high. As you can see, every single time we put in, tackles that level, breaks through. Retest was at that previous high, moves through. So you can see that's the structure. This puts it on warning. Doesn't mean that this can't shoot back up over here, but because it's come through the channel, it's technically put in a lower high as of right now. It does put it on notice to potentially have a little bit of cooling. And a stronger CPI could be something that sort of pushes that. It doesn't mean that it's going to sort of, that's the all-time top, but it does sort of mean that you could see some cooling coming back here. And the same is true for, and this is the point that I was getting at, is that it's the same structure is the same on all time frames. So a bigger move here is up to find resistance, find support, tackle the highs up over here. And that would be your turnaround with gold. A sort of a higher time frame move like this, but booking in a lower high. That's how you'll see a turnaround with gold. Not here coming straight back down. The only time you see it straight back down is when you've had capitulation to the top side, which, because we're moving at all-time highs, and we've come back to these all-time highs pretty quickly, there's no sort of big pool of stops around these levels. So I don't see us having a capitulation. So for this to come back down, I reckon we could have a medium-term trade back down to these levels, but you're certainly going to see another decent $100 plus move coming up here, even if this were to be the highs. So you still need to go through that structure to get back down, and then you're targeting wherever it rallies from and takes out the low. So as I said, the structure is exactly the same. It doesn't matter what time frame it's on, but that's the thing. I'm not investing and I'm not trading six months positions. Would have been good to be trading a 6-month position because gold just went through the roof, of course, but that's not what I do. So anyway, so the point is, how's it actionable from here? Well, short term, you've got a little bit of support, obviously, as we can see, setting up through here. It's bounced from here a couple of times. I think a little bit of a close down, into the mid 30s opens the door to potentially seeing a test of these levels down over here, which is that sort of set 2017 level. Whoops. 2217, 3620, 3617 levels. And then a close underneath here means that we open the door to coming down to these levels over here. So that's the trade through there. But again, as I said, you'd expect a little bit of a reaction at these levels and then sort of see what they do. Second effort is what opens the door to a deeper correction. But the fact that this hasn't just gone and dropped like a stone means that it's obviously still well bid. They're still happy to hold it flat, but they're waiting for CPI. And this is what I'm saying, that a lot of these things tend to sort of move, pretty quite dormantly prior to these large bits of data. Just before I move on as well, the thing that I find interesting about gold here is, where is that bit of data drop last night? Here. This was the bit of data that dropped last night, moved up, and then bang, sold straight into. Yeah, it recovered a little bit, but as you can see, that's where the data dropped. And it pretty much has not moved there at all. It's up, down, up, down, up, down, up, down. Now, that's the second bit of data we've had in 2 days. This is the other one that we had. This is the big mass revisions, and the market sold into it. This should have been, in theory, a reason, another green light for it to go up. This should have been a bit of a green light for it to go up, but the market sold into it, and the market sold into it. To me, that's a warning sign, because sort of like, it was the same thing that happened around the time that they were dropping bombs in Iran. I mean, dropping bombs in Iran, war escalating, yada yada, let's buy gold. That's the reason for them going. What'd they do? They said, oh, great, let's sell into it. You know what I mean? It's the same thing with these rate decisions. The people that are sort of like possibly already in the profit are using for any excuse for more volatility, more volume to come into it as it pushes up, and they're just smashing straight into it. So that's why I think this pullback here is a very plausible sort of trade moving forward, particularly if we do see a little bit of a hotter CPI and a bit of a question mark around next week's rate decision. But what you could see, actually, just playing this out, would be, hotter CPI, pulls it back down here, maybe continuation dribble into these sort of levels. FOMC, they cut, and that could be the time they drive it back up over here. But certainly wouldn't be buying gold at the moment up over here. All right, flip along. Copper, look, I'm going to spend 2 seconds on copper because it's just an absolute snooze fest. Look, it bounced up here a little bit, but this is just turning into just ugly slop. Like, there's nothing really to sort of take from this. I think if you get above sort of 4.7, possibly, but yeah, it's just become a non-trader, really. So that's that. Move along, and we got the yuan. Now the yuan, I've said that this is quite an important chart in my opinion, and it's back here testing this level here again. You got to consider. Well, I'm talking to myself here. You got to consider the possibility that this doesn't hold, and that US dollar continues to get sold. Ramifications if this does come down here. Well, that's going to see Aussie back up pushing probably towards 67 cents. That's one thing. Gold's probably just going to fire back up to the highs, but this is a high time frame bounce. I mean, look at the reaction down here. This is on the 4-hour, 2 attempts down on it. That was just setting up for these sort of things. But when you've got a sort of a trend line like this, you got to question, like, the reaction yesterday was quite odd with the PPI, but again, I think it's mainly off that US dollar weakness, even though actually the US dollar kind of consolidated a little bit through yesterday. But do the PBOC want a super strong yuan? I don't think they do, and I think sort of from the technicals and that, this looks like it should hold through here. But in terms of sort of trade, do they want it as stronger one? And this isn't a sort of okay, that's the answer kind of thing. It's just something that I'm thinking to myself, because it's sort of like, if they have the stronger their currency is, the less it sort of is, well, the more detrimental it is on exports, because obviously it's costing people more to buy this sort of stuff. And that sort of flies in the face of everything that sort of China typically does. So, yeah, but I mean, it's on a strong support. You've had your second effort coming down through here. It's holding here for now. We may not get any resolution till FOMC. But if we start to see this thing push up, hence the alert above 715, I think you're going to see some pretty interesting price action, because this is from that high that it put in around, what's it called day? Liberation Day. What a stupid name. But that was a high there. So we've got a bit of a falling resistance, and you're coming up against, as I said, a weekly rising support. This is like a little triangle that we're looking for a little breakout on. And should this thing sort of pop up to this side here, you're coming through this level here, you're confirming this sort of bounce off the lows over here. I think your first target is 722, and then bigger break above 723 to sort of look back up into the 730s. I mean, that's down the way, but it all starts with a smaller break down here, and that starts with getting above 715. So I think sort of certainly if this thing breaks back up over here, we're going to see Aussie back in its box. We're going to see US dollar running on DXY as well. And that's obviously, I think, sort of going to have the push down effect on gold from its highs as well. All right, that's it from me.